I welcome you all to this YouTube channel. So the first step for anyone to meaningfully learn accounting is to be familiar about the basic terms which are used in accounting. Only when a person is familiar and is quite adept in using those terms can one hope to correctly calculate the profit of a business and to make balance sheets and other such final accounts. So in this first such video in the series of basic terms, in this particular video we'll learn about only one such term, which is assets. Now what are assets? Assets are for a business which has got some value for the business. It has got some economic value. It is owned by a business organization. That means the asset is owned and the asset can be used rightfully, deployed by the business. These assets can be expressed in terms of money, and the most important is future economic benefits can be derived. In simple terms, it is about future income can be derived by using these assets. Now to tell you a little bit more about the third point, that is expressed in terms of money, let me just point it once. To express in terms of money, that means there are many things which a business perhaps owns also, which are quite useful for the business to earn profit. But since those things cannot be expressed in terms of money, therefore that thing cannot be regarded as an asset. One such example could be the human resource of a business. The employees of a business, by working continuously in that particular organization, gain tremendous experience and also gain in their skill set, but this skill set cannot be measured in terms of money, and that is why the skills, experiences of employees cannot be regarded as assets. Now for the purpose of accounting, some examples of assets can be land, machinery, equipment, etc. Now another thing which we'll have to be familiar with, let us read this particular thing. An asset is an expenditure that has utility through multiple future accounting periods or multiple future years. That we have already understood. But the second point, if an expenditure does not have such a utility, it is instead considered as an expense. That means if an expenditure, suppose a business spends money on something and that something cannot give economic benefit to the business for more than a year, then that cannot be regarded as an asset. Examples could be rent, salary, etc. So we are all familiar, we all know that rent is paid mostly on monthly terms. So if you pay rent, it is perhaps for the next month or for the last month. That means the benefit of that rent is available for only 1 month. It will not extend beyond 1 year. If you pay rent for 1 month, that means your landlord will not allow you to stay for more than 1 month. You only get the right to stay for a month, and therefore this is an expense. Payment of rent is an expense. Payment of salary is an expense. These are not assets. This cannot be classified as assets. Now let us see some more features of assets. Number 1, assets can store wealth. That means if a business has earned money over past many years, over the previous years, in that case the business will have cash, and these can be invested in a fixed deposit. So what are you doing by investing in fixed deposit? You are just storing your wealth so that the day when you require that, you can withdraw money from fixed deposit and purchase another asset with that. So this is one such feature of asset, that it has the capacity to store wealth. Even at individual level, if a person purchases a house, that house itself is an asset, but that house also has the property of storing your wealth. That means whenever you require money, you can sell that house and use the proceeds from that money for some other important purpose. Second point, which is the most important, is that assets create income. This is the most important feature. Businesses buy assets, because it helps the business to earn money. So examples as I have given earlier, this can be machine or factory. Another small example which can be given is that if a small stationery shop owner purchases a photocopying machine, then the shop owner can print photocopies and then sell it at 2 rupees, 3 rupees, whatever, and that it can do so for several future years. That means using that photocopying machine, the business or the person, the shop owner, is earning money. So it is a source of creating income. The third feature, which may not be very obvious, is assets reduce expenses. So let us understand this with the help of an example. Say a business has purchased software, say an accounting software. If you see traditional business, for the purpose of accounting, for the purpose of bookkeeping, a business needs many people, say 4 or 5 people for a medium-sized business to maintain the accounts, maybe a little bit more also, say 6-7 people in the accounting department. But if the business purchases a software, then that particular software can be used by one individual and the work can be done faster with the help of that software, and many employees will not be required. So by buying that asset, that software, the business is able to reduce the expenses in the form of salary. So please keep in mind these 3 features of assets, that it can store wealth, it can create income, and it can also reduce expenses. Now let us see the classification of asset, because there are many types of assets which are normally used in the business, and we must be very familiar with the classification. So in this chart, in this table kind of a thing, we will see the classification of assets. So we can see that there are 2 broad categories. One is fixed assets, also known as non-current assets, and second is floating assets or current assets. Under fixed assets, I will tell you the basic difference between fixed assets and floating assets in some moment. But let us see what are the other things which can be seen under fixed assets. So here the list. It can be tangible fixed assets, intangible fixed assets, capital work in progress, deferred expenses or fictitious assets, and deferred tax assets. Under floating assets, we have only one, which are liquid assets. Now before going ahead, let us first learn what are, or how do we classify, or how do we differentiate between fixed assets and floating assets or current assets. That differentiation is very important. So fixed assets are held for long-term use for many accounting years, maybe 7 years, 10 years, or in some cases it may be even more than that. And these are not meant for resale purpose. That means a business purchases these assets to be used in that business, not for selling it again. And third is it increases the profit earning capacity of the business. So if I take an example, say a business has constructed a factory, it has built a factory to produce certain items. So the factory will be there for the business for many years, maybe 20-30 years, and the business does not make that factory to be resold. The factory is there for the business to be used. That is why it is called fixed assets. So let us again recapitulate. The most important criteria to understand about fixed asset is that it is not meant for resale purpose. Alright, it is not meant for resale purpose. Now under fixed assets, as we have already I have given you the list earlier, it can be tangible fixed assets. Tangible means something which can be touched, which can be seen, which can be we can see it, and which we can also identify it has got some physical dimensions. They are relatively long-lived items owned by the businesses. Again, tangible fixed assets are most easy to understand. Land, building, machinery, equipment, furniture, all these are called as tangible fixed assets. In some cases, business may have intangible fixed assets also. Now, these intangible fixed assets can be equally important for business. In some businesses, these are more important. Now, intangible means these assets cannot be seen, it cannot be touched. In other words, it does not have any physical dimension, but it does not mean that they have less value or something. Let us take one example to understand this. Suppose a business has got patent. A business has a patent in some particular thing. That means the business has got the exclusive right to produce that item. No other businesses has the right to copy this particular thing. Okay. So since this business has a patent in its name, so it indirectly gets monopoly power for itself, and because of that it can charge higher price for its product, and because of this the business is able to earn more money. So you can appreciate the fact that intangible fixed assets can be equally important or equally beneficial for the businesses when you compare it with the tangible fixed assets. Another example that can be given is brand. So when you purchase a Levi's jeans, you normally end up paying more amount of money than if you buy a generic jeans without a known or very well known brand name. The difference in the price is because of that brand value of Levi's. Now again you can appreciate because the brand is an asset, kind of an asset, or it is an asset intangible which cannot be which does not have any physical dimension, but nonetheless it gives the business immense amount of power to charge extra money and thereby earn profit for the, or supernormal profit as we say, for the business. But we must remember one important caveat, that these items feature in the balance sheet only if the company has changed owners. That means intangible fixed assets are not shown in the balance sheet unless the business is sold to some other business. Alright. So unlike tangible fixed assets which can be shown by an existing business for in every accounting year as an asset in its balance sheet, intangible assets, brand name, goodwill, patent cannot be shown as an asset. Their value cannot be written in the business unless the business sells itself to some other company. Lastly, let us again take a note of this point, the last point. Even though certain types of current assets such as short-term investments, debtors may lack physical substance, the general practice is to use the term intangible assets only when referring to long-lived or non-current assets which lack physical substance. It means that there are certain other types of assets. For example, short-term investment. That short-term means the investment will mature within say few months or before 1 year. Now although this investment is intangible, you cannot see, you cannot feel, you cannot touch, but still the benefit is not available for many accounting periods, and therefore these are not clubbed under intangible fixed assets. These are clubbed under current assets. Just to repeat again, certain assets, maybe short-term investments or debtors, are meant to be withdrawn before 1 year, and because of this feature, these are not classified under intangible fixed assets. Under intangible fixed assets, there is an interesting concept called amortization. Now we will learn more about this amortization concept in detail later, but for the time being, let us understand the meaning of amortization with the help of an example. Suppose a business has developed a patent through its research and development. It has developed a patent, and the patent is valued at rupees say 1 lakh. And because the business has developed this patent, it will have the sole right to use that patent, or in other words, the business will get a monopoly power over that patent. Now whenever a patent is given to a particular business organization, it is given for a limited period. For our example, let us say the patent is valid for only 5 years and the value of that patent is 1 lakh. Now each year the value of patent will decline, because at the end of 5 years the patent will not have any value. So the business may decide that each year rupees 20,000 will be deducted from that 1 lakh rupees. And that is what we call as amortization. So amortization is that part of an intangible asset which is used up in the current accounting year. We will learn more about this amortization in detail later on, but for the moment this is the meaning of amortization. This another type of asset that needs to be discussed is capital work in progress. Now sometimes many a business they start constructing a new factory or a building, and then it may not be completed in the same year. So for that purpose we need this concept of capital work in progress. Again, let us understand the meaning of capital work in progress with the help of an example. Now suppose a business organization starts building a new office. Okay, alright, it starts a new office. Now we know that construction activity involve many stages, and it takes time to complete the work, and in many cases the construction extends well beyond a year. Now it may just happen that out of the when the time of writing the balance sheet comes, the construction is not completed. So the business cannot write it as an office building because it has not yet been constructed fully. So till that point it is being constructed, the business can write that thing as an asset. It can classify it as an asset, but in a separate category called capital work in progress. Just note one thing, although the word capital is here, but it is still an asset. Capital in business is different, which we will again learn later, but capital work in progress in real sense is an asset, and it is used for those items whereby the construction or building the entire thing has not yet been completed. Let us move on to another interesting type of asset, which is called as deferred expenditure or fictitious assets. Now as you can see, these are not assets in real sense, okay, but still we need to classify them as assets in certain cases. So this is a special case where a business expense is categorized as an asset. Remember, for the purpose of accounting, expenses and assets are different. So one question that may arise in your mind is, why do we classify some expenses as assets, as in the case of this one, current one, fictitious asset? Again, to understand this, let us consider one example. Suppose there is a medium-sized company. There is a medium-sized company and which has undertaken a very big advertisement expenditure. Let me go to that example first. It has spent a big amount of money on an advertisement campaign in the year 2021. Now since it is a medium-sized company and this advertisement campaign, the money spent on advertisement campaign is actually an expense, still if the entire 30 crore is deducted from the income of the current year, that is on the year of 2021, then the profit of that particular year will be reduced by a significant extent, and which will take a big hit on the company's profit for that particular year. Right. Now in order to circumvent this and to even out the profit, okay, so that the business can spread out the profit over several years, what the business can do is that 10 crore out of 30 crore can be deducted each year for the next 3 years. The entire 30 crore will not be shown as an expense in 1 year only. Out of that 30 crore, 10 crore will be shown as expense for the current year, that is on 2021, and the remaining 20 crore out of the 30 crore, 10 crore has been shown in the current year as an expense, and how much money remains? 20 crore. The remaining 20 crore will be shown as an asset in its balance sheet. Now there lies the trick that 20 crore which is shown as an asset is not an asset in real sense, right? It is an advertisement expenditure. But still, in order to even out the profit and to spread out the profit evenly over several years, 10 crore is deducted in the first year. Remaining 20 crore will be shown as asset. In the second year, another 10 crore will be deducted as an expense from the profit and loss account, and the remaining 10 crore will be shown as profit. And in the third year, the final amount, that is 10 crore which is there, which will be shown as an expense in the third year, and nothing will be shown as an asset because nothing will remain. So for the first year, 10 crore is expense, 20 crore is asset. For the second year, 10 crore is expense, another 10 crore is asset, and for the third year, 10 crore is expense and nothing will be shown as an asset, fictitious asset. Okay, now why this is done? As we can see from this current example, that sometimes when a business undertakes a very big expenditure, the entire amount may not be charged because it will create problem to ascertain the profit for that year. And another reason could be this: the beneficial outcome of these expenses, in our case advertisement expense, is expected to be received by the business for say next 2 or 3 years. Hence, it is advisable to show some of the expenses in the current year and remaining one to be shown as an asset for the current year. So there are many other such examples like reconstruction expenses, incorporation expenses, software package implementation expenses. All these are considered as fictitious assets. Again, let me just point it out to you that these are not assets in real sense. These are actually fictitious asset. Fictitious means something which really does not exist. Again, remember, intangible assets are there. It will give you intangible assets such as patents, copyrights, brand name. It will be there in the business for many years, maybe 10 years, 20 years, 30 years, and these will continue to give you profit for that many years. But in case of fictitious assets, this is only an accounting kind of a treatment whereby the benefit is not expected to be received for more than say 3 or 4 years. So it is advisable for the business to write it off as soon as possible, so as to show the clear and fair profit for the business each year. Now let us move on to the next type of asset, which is deferred tax asset. So let us again understand this with the help of this small example, the last one here. Suppose a business enterprise prepays some amount of tax which is actually required to be paid in future, but the business decides to pay it now. So to that extent which it has prepaid, that amount of money which it has paid in advance, that amount of money can be termed as deferred tax asset. Again, to point out, tax is an expense, it is not an asset. But since the business has paid in advance or prepaid the amount which is actually to be paid in future, and it has paid now, therefore it will be termed as deferred tax asset. Alright, so we have completed the fixed asset part, and now let us come down to the second broad category. Okay, just to take you back over there so that you can see where we were actually. We were here, types of assets. So the first type that we have studied was about fixed assets, and then all the different types of fixed assets. We have completed tangible fixed assets, intangible fixed assets, capital work in progress, deferred expenditure or fictitious asset, as well as deferred tax asset. Now let us come to the category B, which is another broad category of assets, also called as floating assets or current assets. Let me just come to that slide. Okay, we are here. Floating assets or current assets. Now, as can be seen here, these are held for resale. Current assets are held for resale, or these are meant to be converted into cash within a fiscal year or within an accounting year, okay, or an operating cycle. So current assets are those assets which are meant for the purpose of reselling or which are meant to be converted into cash. Remember, fixed assets are not meant for resale. Those are meant to be kept in the organization, used in the organization, and earn income through that over a very long period of time. But in case of current assets, these are meant to be resold. They buy it and then they are meant to be resold so that they can earn a profit, or this can be converted into cash within a short period of time, within a year. For example, a shop, let us take the example of a shop which sells mobile phones. Now this shop will purchase mobile phones, it will stock up mobile phones, and then over a period of time it will sell those mobile phones to its customers. So the mobile phones which it has purchased, these are called as stock or inventory, and since these are meant for resale, these are meant to be resold to its customers, therefore these are classified as current assets. Same example can be implemented in other types of business organizations. Suppose there is a garment selling business organization which sells clothes. So for that business, shirts, trousers and other clothing items are regarded as stock or inventory, and those stocks or inventory are meant to be resold. The business purchases those garments so that they can be resold to the customers and earn a profit. So those stocks are called as current assets. There can be other examples of current assets. For example, a business may sell some of its products on credit. So they will find lot many business units which sell their product on credit to its customers. So the amount receivable by the business from its customers in future to whom the business has sold products on credit now is called debtors. So you'll find a word called debtors. Here it is debtors. Now what are debtors? That means the business has sold products on credit to its customers, and the business expects to get the money back from the customers in a few months, maybe 1 month or 2 months. So till the time the business has not received the money, that amount of money is termed as debtors, and it is classified under current assets. Now why under current assets? Because the business will receive the money before 1 year. Now this debtor is also termed as account receivable in many cases, and these are current assets because, as I said, the business expects to receive money from such customers within a short period of time, say within a couple of months. Other examples of current assets could be short-term investments like bank deposits, investment in shares, cash itself, short-term advances. So the main criteria to classify something under current assets is that to check whether this item is meant to be resold, number one, and number two, whether this item can be converted into cash within 1 financial year. Now within current assets there is one more term which is called as liquid assets. Now liquid assets are those which can be converted into cash at a very short period. Now suppose if you have money in your bank account, you just have to go to the bank to withdraw your money to get your cash. And nowadays you can do account transfer as well.